Hello and welcome to Livewire's Buy, Hold, Sell. I'm Anna Dadic. When markets go sideways, as they did recently, investors often pivot to quality, but quality can mean different things to different people. To unpack what that means in the small and mid-cap space, I'm joined by Will Granger from Airlie Funds Management and Marc Whittaker from IML. Gents, let's dive right in. Will, let's start with you. How do you define quality?
When we think about quality, really we're thinking about businesses with durable competitive advantages that are protected from competition and can grow at attractive rates on incremental capital. So really the hero metric there is a business's return on invested capital. If a business has a long-term track record of generating attractive returns on capital, typically that indicates it has some sort of economic moat or competitive advantage. And we then want to try and understand that economic moat to work out whether it can persist into the future.
Okay, Marc, same question for you. How do you think about quality?
Yeah, I'd share that sentiment, certainly on competitive advantage. I think thinking about the resilience of earnings, so recurring earnings is something that we look for in companies that we look to invest in. We want companies that can grow, and we do like companies that can grow their earnings over time. And I think particularly in mids and smalls, and I'm sure Will agrees, but I think management becomes very important. So when you're looking at large cap stocks, you can argue, and CEOs might disagree with me, but if you're the CEO of Telstra or CommBank, a lot of things you do day to day don't really change the outlook or the outcome for a stock. But in mids and smalls, I think management can be very important in terms of the direction and the future prospects for a company. So we spend a lot of time understanding management and the board and understanding how that dynamic works as well.
Okay, Marc, staying with you. When markets are volatile, everyone pivots to quality. Why do you think that is?
In theory, we all own quality stocks all the time, Anna. But I think everyone would like to own a quality stock, but I think the challenge around quality is that often the price that you pay for a quality stock can be quite high. So often the opportunities to buy quality aren't always there, particularly if you're a value manager or a manager focused on quality at a reasonable price. So when you get markets in drawdown sort of cycles, as we've seen recently, and get volatility, often that's a great opportunity to move into quality because you can buy names that typically aren't that cheap or aren't that attractive on a fundamental basis. They're good quality stocks, they're good franchises, good long duration businesses, they generate good cash, but they're priced for that. So when you get these periods of drawdown and volatility, often that's a great opportunity to buy quality. And a point I would make, and I'm sure Will agrees again, but when you get drawdowns in markets, just because you're a quality stock doesn't mean that you hold up better necessarily. When the markets go into a drawdown, often stocks all fall. It doesn't matter whether it's a quality stock or a poor quality stock. So often that's the opportunity, right? You can buy a quality stock at a good price when markets are tough.
Okay, Will, why quality companies now? How do they typically perform in periods of market stress or volatility?
Look, we don't spend too much time thinking about picking stocks based on whether they're going to perform in one market versus another. We're long-term investors at Airlie, so we're always trying to buy a business on a 3 to 5 year view. But I think it does make a bit of sense that investors might want to flock to quality when there's some sort of temporary market disruption. Obviously, as Marc was suggesting earlier, these quality businesses have pretty resilient earnings streams. So, they're the kind of businesses that can thrive in any sort of market backdrop.
Will, I'll stay with you. What are the key characteristics that you look for when you consider investing in a quality stock?
Yeah, well, as I mentioned earlier, obviously the track record is really the most important thing. But similar to Marc's points earlier, we have a strong focus on quality management as well. So you want sort of owner-managed or founder-led businesses. Typically, they come with a long-term investment philosophy and sort of shareholder-friendly capital management. And we've also got a strong focus on buying businesses with quality balance sheets as well. I think that protects you a lot on the downside and also creates some optionality on the upside for you. And then obviously valuation's the other final important piece of that.
Okay. Marc, how about you? What are a couple of non-negotiables when adding a quality name to your portfolio?
Yeah, I'm going to agree with Will again here. All those points are very good, and certainly we think about those as well. I think I mentioned resilience of earnings or end demand for, if a company's producing something or providing something that people want or need, that's a great sign that the company's going to be here for a long period of time. It's going to weather the storm, so to speak. So that resilience of end demand for customers, the inelasticity of demand for what the company's selling, I think is very important. And we talked about growth and we talked about management. I think that they're all key, and certainly in mids and smalls, where I think again Little changes in direction or little changes in strategy can make a big difference to the long-term outcomes of a stock in that part of the market.
Let's get to the fun stuff. I've asked each of the guys to bring along a high quality small cap and a high quality mid cap. Marc, what's your high quality small cap pick?
I've gone with Regis Healthcare, which has had a really nice run in markets of late. It's one of the leading providers in the aged care space in Australia. So when we think about the aged care space, what's happening? We're getting an ageing population, so the bulge in the population that is moving into that stage of life where aged care is becoming a consideration is growing. So the absolute number of people are growing, but on the supply side, the amount of supply that's coming to the sector, given the gyrations and the disruptions we've had in aged care for a long period of time, that supply hasn't kept up. So we're going to have a lag between demand and supply, and that's a great position to be in if you're a provider in the aged care space. Regis is one of the scale providers in the space. And what we're seeing over time with the changes in government policy, government funding, compliance, regulation and so on is you need to be a scale player in order to meet all these requirements and also provide that service to your end patients or end customers. So really like the way they're positioned. Will talked about balance sheets. They've got a very, very good looking balance sheet. It gives them optionality around do they buy or do they build when it comes to bringing on further supply. Very well positioned, very good management team. Linda and Rick, they're doing a very good job. Had a very nice run, but I think lots of time and opportunity in front of it as well to go.
Okay. Will, Marc gave us Regis. Can you top that? What's your high quality small?
Yeah, in small caps, we really like Gentrack. They're a provider of enterprise software to the airports and utilities space. We typically like businesses that sell this type of enterprise software because typically it comes with very low customer churn given how costly and disruptive it can be to switch providers. So that creates very predictable sort of annuity style revenue streams and a very durable business model. Gentrack's been around for more than 35 years, which is pretty unique for a small tech business.
Staying with you, what have you got for your high quality mid cap?
I think News Corp fits the bill here. They own a collection of really high quality assets across the media landscape. If we just look at the earnings power of that business on a look-through basis, 30% of your earnings are coming from realestate.com. It's got probably the best pricing power on the ASX. 45% is coming from Dow Jones, which owns the Wall Street Journal. It's the world's leading financial newspaper and a really high-quality B2B subscription business. And then the final 25% is mostly HarperCollins, which is the second largest consumable publisher in the world. That's an oligopoly market with great long-term returns. So I think that's a really high-quality earnings stream.
Marc, bring us home. What is your high quality mid cap choice?
I've gone for Reliance Worldwide, which perhaps isn't a name that a lot of people would be familiar with, but think about behind the wall plumbing fittings essentially. So you've got your pipes behind the wall, you're in the bathroom or in the kitchen and you need that plumbing to be connected with basically points of interconnection to bring all the tubing and the piping together, and that's what Reliance really focuses on. So leading positions in the US, in Australia, in the UK, and when I say leading positions, still very small market shares, but it's a very fragmented space. Good balance sheet, which means they've got optionality to grow, either through M&A or new product development. They've been very good at that over time. One of the issues for Reliance in the sort of more recent times has obviously been the tariffs that President Trump's introduced and sourcing of supply out of China. The management team at Reliance have been very prescient. They've actually been moving production out of China for quite some time now. So they're very much along that journey in terms of moving to alternative geographies of supply. More recently, just yesterday, in fact, they announced a very comprehensive strategy to basically de-risk all that tariff risk around China with a new corporate strategy. So by FY 2027, the company will be tariff neutral when it comes to supply into the US, which is their key market. The other thing I really like about the company is we talk about resilience of earnings. Plumbing tends to be a very resilient category. Particularly in the US, their business is something like 70% exposed to repair and remodelling. So when you think about businesses that are sort of, I guess, immune to volatility, being exposed to repair, when your plumbing's broken, it's got to be fixed. So that's a very powerful dynamic for that particular company too. And trading very cheaply, 14 times next year, looks really good.
Okay, that's all we have time for today. If you enjoyed that episode of Buy, Hold, Sell, make sure to give it a like and don't forget to subscribe to our YouTube channel where we drop fresh content every week.